So what prevails for you, optimism or pessimism?
Brief answer, optimism. Situation clearly is very difficult, and we're dealing with an unprecedented situation. I think it's a situation that's very hard to compare to basically 2008 or 2000, as you guys were just mentioning. But I think sort of big picture, I think, the fiscal and the monetary injections are massive, with probably more to come. And I think ultimately that will outlast the virus and the outbreak, which, by the way, is starting to show, increasingly positive signs of apex or perhaps post-apex already in Europe. So, yeah, optimism is my brief answer.
You got us putting 700 points onto the S&P by next year. How in the world are we going to do that?
So that's a good question. And look, frankly, we get a lot of pushback on that. So everybody's now clearly focused on the damage done to the economy. What will earnings look like? And frankly, I think it's a little bit of a pointless exercise to sort of try to talk now about what's going to be EPS for 2020. Is it going to be 150? Is it going to be maybe 130? We don't know. Companies are dropping guidance left and right. So I think what we need to sort of focus on right now is basically, first of all, the path of the outbreak, because I think ultimately that will dictate how quickly the economy opens. Two, it's not just about the hit to earnings, but we have to think about the hit to earnings relative to the change in the monetary base. Now, this is a big statement because what the Fed is doing is unprecedented. And I think a lot of investors have still not fully comprehended that and sort of put their head around it, right? When the Fed basically goes out and tells you unlimited QE, or the fact that they're basically buying high-grade, investment-grade corporate debt, that will have an implication for equity multiples. And so I basically think that, yes, we will see a big impact to earnings, but the environment that we're living in, and most likely that we'll continue to live in, is one of elevated multiples. And I think that U.S., specifically S&P 500, is the home of many, many stocks and companies that are asset-light, that are beneficiaries of, call it, this unprecedented monetary policy. And so I can totally envision a situation where earnings start to recover. They're not perhaps where they should be, but multiple re-rates on account of some of these non-fundamental forces. And then add to all of that one more element, positioning. Positioning has derated quite substantially, especially when you look at fast money, be it the systematic side, be it the hedge fund side. So there is upside there as well.
But what about, you take earnings out of the equation, there's going to be a tremendous hit. We get it. I take your point for what it's worth. What about the hit to the American psyche? I mean, that's unquantifiable, and it's going to be large, isn't it? I mean, we are a resilient population, but we're also not stupid. And we're not going to walk back into what may be a hornet's nest if we think that there are still issues to be dealt with relative to the virus. And maybe that supersedes everything. All of the forecasts about earnings and whatever multiple you put on it, you can't put either of those on my psyche or that of my fellow people who are going to be apprehensive to go out and go into a restaurant or go into a hotel or go into an airplane or go into a casino or go into a movie theater or any other of these venues where the risks are going to be perceived to be high, right?
No, I agree. Look, you mentioned something that's very fair, and that's a risk. But the way I would basically think about it is, first of all, the country cannot stay in a lockdown for a long period. People will need to basically go back to work. And again, you have to sort of separate between sort of the upper income, the middle and the lower income. The middle and lower income people, want to go back. They need to make money. They need to pay their bills. So I don't think that this lockdown situation can persist forever. I think this is a temporary. Second of all, certain parts of the economy will not open up immediately. Or if they open up, they're going to open up in a rather slow fashion. And you mentioned a lot of these industries like entertainment, leisure, and so forth.
No, but aren't those the most important parts of the economy?
Well,
we're a 70+% consumption-based economy. If the most important parts are going to have a lock on the door.
Yes, but I say that if 75 or 80% of the economy sort of starts is back up and running, the other 20-25% could get filled, that gap, through all of these injections, be it on the fiscal, perhaps even more so on the monetary side. And that's what I'm saying. You have to sort of look at the picture more holistically rather than just, the impact to the economy, impact to earnings. I think there's a lot more happening.
Okay. But that's fair.
Hey, Scott?
Yeah.
Scott, Dubravko puts it much more eloquently than I did, which is that as I look at it,
I'm not going to argue with you on that.
What's going to?
But please carry on.
I mean, nobody will actually. Not even my wife or kids. And they don't even know Dubravko. But if I look out a year, what's going to survive? Is it going to be the virus still being around, or is it going to be monetary and fiscal policy? It's going to be the latter.
That's right.
Number one. Number two, the reason why I'm carrying greater exposure than I did, I was on the CDC website yesterday. There are 300 ongoing registered trials for a therapeutic or a prevention for COVID-19. If one of those hits, that's the magic bullet. You don't want to be sitting with any cash. Now, I'm sitting with a lot of cash, but I'm also more exposed now than I have been over the last month.